There's one structural question in every business sale where the buyer and seller may have directly opposing interests. It's not price. Buyer and seller both want a fair price. It's not the closing date. Buyer and seller both want certainty. It's not even the non-compete. It's whether the deal is structured as a share or an asset sale. The buyer often wants an asset sale. The seller almost always wants a share sale. And the reason for both comes down to tax and risk mitigation. Potentially hundreds of thousands of dollars worth. This episode is going to explain exactly what each structure means, why interests may diverge, and how a good advisor finds a path that will deal with what actually works for both sides. I'm Chad Graham, an Alberta corporate lawyer, and this is episode 7 of From Build to Sold. It's the most consequential structural episode of the entire series. All right, let's talk about the fundamental difference. In a share sale, the buyer purchases the shares of your corporation. The company itself does not change. It continues with all of its contracts, employees, licenses, liabilities, and history intact. The only thing that changes is who owns the shares. You walk away, your buyer steps in. In an asset sale, the buyer purchases a specific list of assets from your corporation. The company does not transfer. The buyer acquires equipment, goodwill, and customer relationships. The intellectual property, perhaps, the inventory, whatever it is that's listed in your purchase agreement. But the corporation itself remains with you, the seller, even after the transaction. Now that difference, whether the corporation transfers only its assets or its ownership, that difference has enormous consequences for both sides. Let's take them both in turn. Why the seller might want a share sale. Now, we covered the lifetime capital gains exemption in depth in episode 3, so I'll keep this tight. The LCGE is available under the Federal Income Tax Act, and it can shelter over $1 million in capital gains from tax on the sale of a qualifying small business's corporate shares. For many Alberta business owners, it's the single largest tax planning opportunity of their professional life. It's only available on a share sale. On an asset sale, your corporation sells its assets. Any gain realized at the corporate level is taxed inside the corporation. The after-tax proceeds then need to be extracted from the corporation through dividends, salary, or return on capital, and they are then taxed again at your personal level. This double layer of taxation on an asset sale is the reason sellers fight hard to keep it as a share sale. Now, your CPA will quantify the exact difference for your specific situation, but to give you a very general illustration, on a $2 million gain, the difference between qualifying share sale with a full LCGE access and an asset sale can easily represent $300,000 or more in additional tax. That's not a rounding error, that's paying off your house mortgage. Buyers, on the other hand, typically want an asset sale. Why? Well, it has to do with the cost-based step-up. From a buyer's perspective, an asset sale has a significant tax advantage of its own. When the buyer acquires assets, they get the full cost-based step-up. The assets are recorded in the buyer's books at the price they paid. Future depreciation deductions, for example, capital cost allowance, in Canada's tax terminology, calculates on that new higher cost basis. Over time, this means meaningfully more tax deductions for the buyer. On a share sale, the buyer gets no step-up. The corporation continues with its existing asset cost base, the historic unappreciated capital cost that was on the corporation's books before the sale. The buyer has now paid a premium for the business, but they cannot depreciate that premium. For a buyer acquiring an asset-heavy business, a trades company, for example, with significant equipment, the cost basis difference can be very meaningful. It's not irrational for a buyer to prefer an asset sale, and it's not irrational for the seller to prefer a share sale. Their positions each have legitimate economic bases. Here's some of those other differences in liability. While tax is the biggest driver, it's not the only one. Let me walk through another few key differences because they matter in your negotiations. Historical liabilities. On a share sale, the buyer acquires the corporation including all of its history. Known liabilities, unknown liabilities, contingent liabilities, and undisclosed liabilities. If there's a tax problem from 3 years ago that nobody has yet discovered, the buyer inherits it. On an asset sale, the buyer acquires only the specific assets and assumes only the specific liabilities in the purchase agreement. They're insulated from the corporation's history. This is meaningful protection for buyers, particularly in industries where regulated environmental or employment liability risk might exist. And then contracts. On a share sale, all contracts of the corporation continue automatically. This is great. The corporation is the contracting party and it hasn't changed. Subject to any change of control provisions, which may be in those contracts. We discussed those in episode 5. Your customer agreements, supplier agreements, and leases all survive without requiring counterpart consent. On an asset sale, however, contracts cannot be assigned, typically, without consent. Every material contract the buyer needs in order to operate the business has to be transferred. And that transfer requires the counterparty's agreement. If your 3 largest customer relationships are governed by contract with assignment restrictions, an asset sale creates an execution risk. And employees. On a share sale, employees remain employed by the corporation without any interruption. Their employment is not affected by the change in ownership. There's no termination, no severance obligation, no requirement to rehire. On an asset sale, employees of the selling corporation do not automatically become employees of the buyer. The buyer is a different entity altogether. They're not acquiring employment relationships. And practically that means employees are terminated by the selling corporation and offered new employment by the buyer. Now, this becomes interesting because Alberta's employment code addresses continuity of employment in certain asset sale situations, but it's very fact specific. Whether a particular employee is entitled to severance from the selling corporation or whether the prior service is recognized by the buyer requires specific legal advice. Sellers should understand their employment obligations before agreeing to an asset sale. Let's bridge the gap. How do we find a deal that works for everyone? How do buyer and seller resolve this tension? The honest answer is money. If a buyer insists on an asset sale and the seller has LCGE eligibility on a share sale, the seller needs to be compensated for the additional tax cost. This is sometimes called a price gross-up. An increase in the asset sale purchase price sufficient to leave the seller in the same after-tax position they would have been on a share sale. Now the CPA will quantify that gap. The lawyers will document the structure. And the negotiation becomes this: is the buyer willing to pay more to get an asset sale structure they want? And often the answer is yes. Because the buyer's cost-based step-up has real long-term value to them and paying a modest premium is rational. In fact, in some mid-market transactions, the parties may use a share sale with a tax election under the Income Tax Act that allows the buyer to get a partial step-up in asset cost base in addition for price concession. But this is where it gets really sophisticated, and we won't touch on that here. You need to talk to your CPA. Here's the practical rule. Settle the structure question at the LOI stage. Don't leave it unresolved. As I said in episode 6, a buyer who gets you into an LOI with an unresolved structure question and then demands an asset sale during the purchase agreement has cost you leverage you cannot easily recover from. Now, one Alberta-specific legal point on asset sales worth naming clearly is PPSA searches. Before closing on any asset sale, a buyer should conduct searches under the Personal Property Security Act. If there are security interests registered against those assets, the buyer needs to confirm they'll be discharged on closing. Acquiring encumbered assets is not something a careful buyer wants to do. As the seller, you should be prepared to discharge any PPSA registrations against your assets before or at closing. Unresolved security interests are a closing condition that can complicate or delay your transaction. Asset sale or share sale? Sounds like a technical legal question, yet it's actually one of the most financially consequential decisions of your entire exit. The takeaway from this episode is simple. Do not agree to a sale structure without understanding its full tax and legal implications. And don't let the structure question go unresolved past the LOI. Episode 8 is going to cover due diligence, what a buyer's team is going to look for. and how to prepare your data room, and why the disclosure schedule is the document that protects you after closing. That's next. If you have a buyer proposing a structure that you want to understand what it means a little more, visit chadgrahamlaw.com, look in the link in the comments. We work with your CPA to find the structure that gets both sides to yes. I'm Chad Graham. See you in episode 8.